Hello and welcome to Your Money, Your Call. I'm Kim Slater. Here tonight for share market insight and analysis is Ben Clark from Kimber Capital and Francesco Destratus from Ord Minnett. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. So welcome to the program. We hope we'll have a very informative hour for you this evening. Gentlemen, it's been an interesting week in the market. The market is up one day, down the next, gyrating around. We've got a whole heap of things happening globally and domestically. The biggest one of those, of course, is Jackson Hole and Ben Bernanke on Friday night. And in the middle of all that, we've got the spot iron ore price falling below $100. Interesting to see today that Fortescue got slotted another 5 to 6%. Firstly, Ben, I know you've been negative on Fortescue. When do you think the falling knife is going to stick in the floor as far as Fortescue is concerned, and as far as iron ore as well?
Yeah, it's a good question because we get a lot of calls on the show about it. But my concern with Fortescue has always been the level of debt that they're carrying. The expansion to 155 million tonnes at Christmas Creek, that can't be stopped or slowed down, even if the iron ore price, say, went to $50 or $60. The company must push ahead with that. And when you look at the level of gearing on the balance sheet and where iron ore is currently trading, I think if it falls much further, or even if it stays at these levels for too long, the bankers are going to start to get pretty nervous. And Atlas is in a stronger cash position. I know it's another one we get a lot of calls about. It's got no debt at the moment, but again, it will be taking on a lot of debt in its expansion. That's what I think a lot of people don't realise, is what the levels of debt will be once these expansions are completed.
Well, if I can just jump in there for a sec, because there's an interesting point here that Fortescue needs about $1.5 billion of cash flow, and we'll come to you in a sec, Francesco. $1.5 billion to finance the final capex spend on the ramp up of that 155 million tonnes. So it has all these assets on the balance sheet. Like it has power stations, it has infrastructure, it has the accommodation units which can be sold and leased back. They have airports. So there's probably somewhere like $3 to $4 billion of assets that they could sell to to bridge this cash flow problem. Don't you think that in itself is enough to make people think a second time about, well, there's not going to be an equity raising, and all they really need to do to show the market that they've got enough in place is actually to do one of these asset sales?
No, I personally don't. I mean, Fortescue, it produces at $55 a tonne, but when you take into account the cost of interest coverage and the day-to-day costs of the expansion, we reckon close to $100 they're actually not making. They're not making much money out of the iron ore. And it's not just about. It's sort of like having a house that's worth $1 million and a mortgage against it that's worth $800. If your income drops markedly and you stop meeting your mortgage repayments, your bank's going to start getting nervous. And I think an asset sale could almost send sort of the wrong message to the market. In that they're feeling the pinch themselves. So.
Okay.
Look, I'd still be avoiding it. If I was in it, I'd actually, to be honest with Fortescue, I'd actually probably still be selling it. I still think it's too dangerous a predicament. And there's other iron ore stocks, if you like the iron ore space, such as BC Iron, which has got no debt, lots of cash, and a much sort of cleaner sort of cash flow, that I'd be looking at if you like the area.